Welcome to the latest podcast. We trust you'll find this information informative and valuable when making decisions about what investment strategies may be most appropriate for you. Now, as you listen to the podcast, please make a note of any questions you have and then email them to hello@mrdpartners.com.au and we'll be back in touch to answer them individually. This podcast brings together two areas of expertise, financial planning and real estate investing. And I've invited Dale Drew from Live Now Financial Planning to the podcast to show you how, when experts team up, the clients win. Now, before we start, I'd like to draw your attention to the disclaimer on the screen. This podcast is not a substitute for professional advice. Rather, it's educational information that's designed to help you make better and more informed decisions that can lead to greater wealth. It's also designed to help people maximize their results by considering ideas and strategies that come from a financial planner. Firstly, and for the benefit of those not familiar with MRD Partners, we're a boutique family business now in our 16th year of operation, and we've been committed to partnering with and supporting property investors since the 15th of May 2002. Hello, my name is Nick Lockhart and I'm a family man married for over 30 years with 4 adult children. I'm actually mad keen about property, or more importantly, what investing in property will deliver when done the right way. This is actually why I founded MRD Partners over 15 years ago. I love bringing sound education and real wealth to people's lives. It's something I do daily. I have skin in the game, which means Katrina, my wife, and I are both investors with our own property portfolio. And it's been a goal to be able to help our children get into property. And I'm excited to say that just last Friday, our son and his fiancée settled their very first property. And that was a real buzz for us to be able to do that for them. Now, as mentioned, we're fortunate to have with us today Dale Drew. Dale, thanks so much for making time to share your expertise with us today. You want to just say a quick hello?
Hi, Nick. Thank you, and welcome aboard, everyone.
Thank you. In just a minute, can you tell us just a little bit about yourself and how Live Now Financial Planning came into being and what it is exactly that you do?
Absolutely. Thanks, Nick, and welcome, everyone. Firstly, thank you for inviting me to be a part of this podcast. It's very exciting for me to do this, and technology allows us to do it, which is great. Just a bit of an insight. I'm 44. I've been married for 20 years, very happily to my wife, Marie. We've got three boys, aged 17, 14 and 7. We live on the beautiful Sunshine Coast, and we've done so for over 30 years. It's a wonderful place to raise a family, and we couldn't think of a better place to live. My business started after leaving the Queensland government in 2002. I went back to university and started studying. I had an interest in finance and property, and I thought the best way to do that was to get hands-on. I was lucky enough to pick up a cadetship with Westpac, and after 3 years with them, I had achieved the result of becoming a senior planner. But I was a little bit concerned about their service offering for how they treated clients. It was very typical of a bank, I thought, where they simply wanted to obtain numbers, and that didn't really sit with me. And I guess over a period of months, I was fortunate enough to meet a young man. I started consulting for him as an individual, an independent business here on the coast. And that pretty much started. And from 2007, we actually bought the business, rebranded it, and my wife and I, who is my office manager, have been running this business now since 2007. So we're in our 10th year, which is wonderful, and we've got a growing client base, predominantly focused on financial planning, which is wonderful.
Fantastic. Thanks, Dale. So Dale and I work in different areas of money, and although our areas of expertise differ, there's a lot of commonality in the fundamental reasons people come to see us. So we've created this podcast to give you certainty and a clear direction forward. Escape the extreme money stress that 2 million Australians are experiencing, and a further 10 million are living with some level of financial worry. That's actually research from the Centre of Social Impact conducted by the NAB. So this podcast will also give you some time to reflect or assess where you're at in terms of your personal wealth goals. Security is another one, and we know you want security. You want reassurance, confidence, and a clear pathway forward, because you want to be able to rest easy knowing you have a successful future plan. Tactical plans and tactical steps. No doubt you want to hear case studies about real living people who have created financial success by bringing their experts together. And you want to know this so that you can follow in their footsteps. So we've tried to make, I've looked at this and thought it was really a refreshing approach to wealth building, because traditionally, and you see this a lot with financial planning and with property investing, you deal with companies that are really focused on transactions. And the thing I love about Live Now and Dale is he's got the same attitude toward his clients as we do toward ours, and that is we partner with them for the long term. It's not a transactional approach. Now, in my industry, a transactional approach is simply secure a property listing, you market the property, and then you're looking for the buyer to sell that property to. Whereas the partnership approach is we start with the investor, we undertake a comprehensive discovery session. From there, we develop a tailored strategy, and the strategy determines the property that best suits the client's need, and then we go and source that for them. And I know that Dale's business model is also one of partnership, where he's more interested in you than one-off transactions. Okay, money mistakes that go undetected by people that might not seem a lot but cost them a lot. First of all, not keeping an eye on super. We see this devastating story too often. Someone close to retirement comes to us and says, I noticed that it was not growing all that much, but I kept hoping it would pick up. Look, super is right up there as far as your assets are concerned. You know, there's a lot of people, they get to the retirement age and they've got equity in the family home and some money in super, and that's about it, sadly. But it's really, really important that we pay attention to what we have in super and what's being done with it. You got anything to add?
I see this. Oh, absolutely. I see this all the time, Nick. I'll tell you a quick story just to help explain. I met a wonderful couple from country New South Wales about 7 years ago, married in their late 30s. With 2 kids. They had the typical family assets. They had a house, they had a car, but they also had some debt. And the issue for this particular gentleman was that he had 12 superannuation funds.
Wow.
And the worst thing was he didn't know where they were. He was an interstate truck driver, had been travelling around Australia, and this is before superannuation portability came in 2005, so he had no choice but to move from super fund to super fund. Anyway, with us involved, the idea was, well, you know what? Let's find all 12 of these. Let's get them into one super fund. We managed to save him over $1,000 in fees each year, and we helped him organise all of his insurance inside the super fund. So the super fund was actually paying for the premiums, which was amazing for them because. Being in country New South Wales, their income wasn't overly high, so this helped them manage their cash flow. And look, this is very typical. We just see Aussies who they get their superannuation statement and they throw it in the fruit bowl, and they forget about it.
Yeah. Yeah, that is so very true. And one of the clients that we're working with at the moment rang me last week, all excited. We'd been through and shown him how to search for his lost super, and he rang up because he found a fund that had $30,000 in it that he said he had no recollection of, no memory, and the beneficiary was his wife, but her maiden name, that's how old it was. They've been married, I think, for close to 30 years. So
that's amazing.
Yeah, and look, that 30,000 has made the difference. He's actually said to me, so with this extra money, are we in a position where we could look at a second property? He means a property and super. And I said, well, let's let the dust settle. Let's get number one done first, and then we can reassess and have a look. But without that 30 grand, it was not a consideration. Now it is a talking point. So yeah, it's amazing how people lose their money.
Yeah. Yeah, I agree.
All right, not looking out for deals on more favourable borrowing arrangements is another mistake that people make. And it's all too common to see people hemorrhaging money. It's often the little daily expenses that hurt the most. And so this is where we say to people, just stop, breathe, relax. Like, don't get stressed about what you haven't done, what you've neglected, whether you've got missing super or, you really haven't had your home loans checked for a long time and you don't know whether you're getting the best deal that the banks are offering today or not. Just take a deep breath, and it's not what you haven't done in the past, it's what you're prepared to do and the action you're prepared to take going forward. Dale, I would be correct in assuming that you've had clients that have sat with you that have been terrible money managers, but they get to a point where they're ready to be ready and they've made the decision they want to change, and they come to you for coaching and guidance. And because the student is ready, the teacher can help them, and 5 years later they're in a very, very different situation to what they would have been.
Exactly. Happens more than you think, Nick.
Yeah.
I mean, it's phenomenal. It just happens. I would say probably 3 to 4 people every month.
And it's funny too, because the amount of people who I'm now friends with, they started out, a stranger client and became a mate or a friend, but the amount of people I'm friends with who, you could almost say they became investors by chance. Through a chance meeting, an introduction, chatting and talking, and they asking questions, and little by little, and they got to the point where they said, this is awesome. I wouldn't mind doing this. They buy one, they move on to another, and so forth. So, I suppose the lesson to take out from that is that we should be intentional in seeking out advice, information, looking for areas where money is slipping through the cracks. Indecision and procrastination is another big one. Have you noticed too many people are more interested in being armchair experts than taking personal action? I mean, it's footy finals time at the moment, and it's the same with sport. But yes, taking action often requires being courageous. Action taken ought to be considered and based on education and well thought out plans. And it's important not to be reckless. Don't make mistakes that are avoidable. And when we do things that are reckless and stupid, don't think it's courage. It's not. Courage is not being reckless at all. So no contingency when things go wrong is another area that people make mistakes. For example, unable to earn an income due to illness or worse, death. My dad sold insurance, Dale, when he was young, and he tells the story of one of his co-workers went to see the owner of a business, and he sat and he did his sale, his pitch, and the owner said, that's great, I want to think about it, come back in 2 weeks. And the guy, but sir, you don't know, what's going to happen in the next 2 weeks. You could lose the ability to earn an income, or worse, what if you were to die? And the guy just sort of chuckled and smirked and said, look, nice try. I'm not interested. I don't want to do anything now. If you want to talk to me again, do it in 2 weeks. And so the guy got up, packed up his briefcase, turned, shook the guy's hand, went to walk out the door and dropped dead in his office. Literally, this is a true story. The guy's selling the insurance. And the bloke was so freaked out that besides calling, an ambulance, he rang the insurance company and said, send me round another rep. I want to sign up straight away. And my dad tells the story because he was the other rep who went round and signed the bloke up.
Oh, really?
He was talking about the commitment of his colleague to getting the sale.
Yes.
But look, jokes aside, I mean, it's obviously, it's not a laughing matter. When we're 20, we think we're Superman and bulletproof, but illnesses and accidents do happen. The impact of a devastating illness is bad enough to have to deal with, but the negative effect is only further compounded when someone loses their house, is wiped out, a completely avoidable situation had the person bothered to think and plan ahead. Listening to the wrong people, that's another mistake that people make all the time. Being influenced by people at your footy club or your Facebook news feed, listening to your mum or your brother, etc. That's okay if they've got the results that you're after. We really should be listening to people who have done what we're wanting to do. When the consequences of advice is significant, I say only take it from people who are experts. And we define experts as people who have skin in the deal and a high degree of education in their appropriate field. And lastly, making emotional decisions, or more importantly, not making them when it comes to our investments. Not treating your investment portfolio like a business is a mistake. Selling your property because the last few years haven't performed as you hoped is emotional. It'd be like you going to work, Dale, and shutting up the business because the internet was down on Friday and going, oh, this is a joke. Can't run a business with no internet. I mean, things happen. And as a property investor, I say to people, when things go wrong, not if, but when, because something will somewhere along the line. You'll get a phone call saying there's a leaky tap or tenants are complaining about something. When things happen, pick up the phone and call us. Treat it like a business. So both Dale, who's a financial planner, and me, Nick, a property strategist, are professionals, and we're paid to assist clients move closer toward the realization of their goals. We both agree that reasonable risk mitigation measures should be put in place. And at the end of the day, we're both setting out to achieve the same outcomes for our clients. So then that poses a question. Why does mixing financial planning with property expertise seem so much like trying to mix oil and water or trying to get a Holden enthusiast excited about the latest Ford? It shouldn't be the case, nor is it with Live Now and MRD. And I put it down to the fact that, Dale, you partner with your clients for the long term. It's not about a single transaction, and we're the same. And you recognise that you don't do everything, and I recognise I don't do everything.
That's exactly right, Nick. And MRD have proven themselves time and time again to be the property specialist. And that's an asset class that is, that's your niche. That's what you do, and you do it very well. We are, in this particular field, as you put it before, the mitigation of risk in that particular area is just as vital as choosing the asset itself. Because without that risk management, the deck of cards can stumble, and that's our job, and that's why financial planning and property expertise do go hand in hand.
They should,
because we're there to support the client, and it's the way it's always been. But unfortunately, it hasn't. It's never been clear.
Yep. Absolutely. So while Dale and I recognise that a number of investors want assistance investing in both worlds, that is, you want to hold and afford, we also recognise the importance of and respect the value that each other adds to an individual investor's situation, which is basically what you just said. So let's have a look at a couple of lessons. Valuable lesson number one, there is no Australian property market. It is a market of markets. And when you hear them talking about median price, property in Australia, the median price did this over the last quarter or the last 12 months, it really doesn't amount to much at all, because it's a market made up of many markets. Australians have always seen real estate as an attractive investment vehicle, but with interest rates still lingering near historic lows, it's exceptionally attractive right now. And in Australia, we enjoy a property clock where different parts of different cities experience growth cycles at different times. The most successful investors invest with their heads, not their hearts. And in Australia, there is always an emerging market that we can target and source great properties in. I mean, you live in one right now, and so do I. 5 years ago, it was all about the Sydney market, then the Melbourne market, and southeast Queensland is having its time in the sun at the moment. But because of their growing populations and diversity of employment, at MRD we focus on property in the Greater Brisbane, Sydney and Melbourne property markets. Of course, subject to where they are on the property clock at the time, entry prices, rental yields and clients' needs. So when we talk about Greater Brisbane, we're really talking about Sunshine to Gold Coasts and out to Ipswich. Sydney, Greater Sydney would take in, say, Campbelltown, and Melbourne would take in Geelong, just to give people a little bit of a reference point there. Another valuable lesson is trusting the wrong people. We do need to have people in life around us that have our backs, that we trust. People who will tell us what we need to hear, not what we want to hear. But we need to trust experts who are experts in their field. So if it's a medical condition, you need to get a specialist who is an expert in his or her field. And when it comes to investing, you really should be taking advice from experts. In your next appointment, ask your expert, what do you invest in? What are you in for? How much that is? And what was your biggest mistake, and how do you track your success? If he or she can't answer your question satisfactorily, it's perhaps best you move on and find a real expert who actually has experience and skin in the deal. So we live in a highly complex, changing world. Yesterday's financial successes cannot automatically be replicated today. And the true savvy investor recognizes there is a less rigid approach to wealth creation. Instead, they see there are huge gains for those who want multiple sources of income. So the need for a hybrid of experts is growing. That is, real estate mentors and financial planning experts together, and of course, topped off by a really great accountant who understands your investment strategy. So let's look at some points of commonality between property investing and financial planning. And as you can see on the screen, there's a number of these areas of commonality. Now, I'm going to give my voice a little bit of a rest. Dale, you want to just talk about some of these areas?
For sure, absolutely, Nick. Whilst you have a drink of water. So these are the areas that I find to be most common between, especially Live Now Financial Planning and MRD. Insurance. Ask the question, are you borrowing to invest in property? Now, for most of us, the answer will be yes. So if we're going to borrow, then we need to protect our assets. And as Nick mentioned in the previous slides, we refer to it as risk mitigation or risk management. Protecting your assets, protecting your income, and subsequently protecting your family through these insurances is absolutely vital. And I would say that 80% of my business, day to day, Monday to Friday, is made up of protecting people's families, protecting their income. What happens if you can't go to work tomorrow? It's something that, the underinsurance gap in Australia is closing, but it's been one that's been in excess of 50% for many, many years. We ask the questions, do you still have the appropriate levels of cover, the right level of cover, so that you're not underinsured, nor so laden down with insurances that there's no room to invest. So there's a fine line in the sand, and that fine line separates what you need versus what you can afford. And it's our job to make sure that it's clean, that you understand exactly what you're insured for, there's transparency, and using your super funds and your self-managed super funds even better can be a real cost-effective way to pay for that insurance. Now, sometimes cash flow is the key to ensuring the survivability of your property. We all know that. Cash flow is king. And I actually had a phrase that a property investor told me a few years ago, and he said that he described his house as his investment property as it's gone from a cash cow to a cash pig. And I actually asked him, I said, "What do you mean?" And he said, "Well, unfortunately, Dale, it's one of those things where I think I've chosen the wrong property, and it just didn't turn out to be that he was hoping for, because he listened to the wrong people. I think he listened to a friend of his at a barbecue, and he unfortunately had to sell that property. But it was just one of those things where his cash flow determined the survivability, but it also then determined his attitude moving forward. So our job is to let you understand that yes, you can use your super to fund your insurance premiums. Absolutely. It's a very cost-effective and tax-effective way as well. It's a very individual decision though, and we make it very clear that what might be right for one person may not necessarily be right for the next.
Yep. All right, let's move on to estate planning and super.
So estate planning, otherwise known, people probably have heard the phrase of, I haven't had my will done, my last will and testament. It's a fairly, it's seen as an area for a lot of people that, that's not something I should do until I'm in my 50s or 60s. That's actually a misconception. Having your estate plan done is just part of the equation. We all have super. Our superannuation lives start from about the age of 18. So when we're first employed. So it's whenever you start a super fund, you will always be asked to nominate a beneficiary. Now, the beneficiary is that person that you nominate for your money to go to, should you die. Now, that goes hand in hand with your last will and testament, because there could be money sitting in super that might be lost, that your loved ones and your dependents are entitled to, but because of this lack of expertise, it's escaped you, and it's something that you haven't done. So we talk about that. We talk about what happens to your assets, your spouse and your children upon your death or your disability. Where does your money go? How do the banks treat those assets, especially if you have a debt on those properties? It's a complicated area. And now more than ever, Nick, we're seeing a lot of blended families. So where there might have been a marriage breakdown and two children have come together with another family of three children, it can get very, very complicated, especially when there's adult children involved, and we're talking about a large portfolio of super and assets.
Can I ask you a question on all this?
Of course.
Just back to my mate who found that $30,000. If something had happened to him, I mean, his wife didn't know. I mean, that's so long ago. If something had happened to him and he passed away, does anybody look for, like, as part of tidying up someone's estate, is it a standard practice that they go and look for lost super or anything like that?
My understanding is yes, they do. But given that the fact that his beneficiary was his wife, but it was in her maiden name, is that correct?
Correct, yeah.
Yeah, so with technically that nomination is no longer, basically it's void because she's now changed her name. Effectively what it means is, yes, the super can be found and that's fine, but the issue is if that particular beneficiary, if that nomination is then void, the issue has that money would then go to, assuming that he has a will, that money would then go to his estate, and the framework and the parameters around that estate would then determine who that money goes to. But we do see people that don't have a beneficiary and they don't have a will, and that money ends up going to the public trustee for them to determine where that money goes, and it just the more levels you go up, the uglier it gets. Let me tell you,
I can imagine.
and it's frightening. Actually, it is really frightening. So there's lots of questions. We entrust this process with a specialised legal firm. I often say to clients, Nick, if you have a relationship, like you said before, if you have a fantastic accountant, then hang on to that accountant and make sure that you don't let them go because they are worth their weight in gold. The
Yeah.
same can be said with a solicitor. If you have a trusted partner that's helped you with the acquisition of a property, they've helped you with a family law matter, or they might have done, your estate planning for your mum and your dad, and you trust them implicitly. Go to them, speak to them about what your wishes are, and let them guide you through the process. I always believe in this circle of expertise
Mm.
that clients are in the middle,
Yep.
and I think I've explained this to you before. The clients are in the middle, and we have a circle of influence.
Yep.
You've got Nick at MRD, we've got Dale at Live Now, we've got your accountant over here that's providing you with wonderful strategies and structures, and you've got your solicitor, and we're all working for the client. And
Yes.
I think if you have that, then you can put a tick in that box and you move on.
Yep. That's very good. Okay, the other area, or another area, is taxation, and the consequences as people move closer to retirement. Do you want to just touch on that for us, Dale?
Yeah, absolutely, Nick. Look, this is a treacherous area and it can cost you a lot financially. If you're an SMSF investor and you're not far away from retirement, what plans do you have in place to remove or kill your debt? Tax planning is absolutely crucial, especially if properties are held within a super fund or in that environment. And if you've got debt on them, even more so. It becomes very complicated if properties are held outside of super and with debt also. So we must remember that the super environment is still the best place for your retirement assets to be structured due to the generous benefits that they allow, especially from the age of 60 and over. So paying income tax outside of super once you're over the age of 60 is not considered to be a good strategy. Good tax advice from an experienced accountant who can work with your planner is a bit like your builder working with your electrician. It
Yep.
has to happen. And that's the only way that you can ensure that the house gets finished the way that you want it, so that the left hand is talking to the right hand. It's absolutely crucial.
Yes. Perfect. Okay, let's move on to retirement planning.
Mm.
Planning for retirement with a
Look,
qualified planner enables someone to work toward a strategy for leaving employment, and this is important, converting the assets they've accumulated into income producing vehicles. That's a really important step
absolutely.
for people.
Well, yeah, it is, and it's a phase of their life that they don't understand too much. So, getting together with a financial planner, understanding what retirement actually means, and we emphasise this all the time. Don't underestimate how important this phase of your life is. Converting your assets to income producing vehicles is something that needs to be addressed. And we normally lay the seed at about 5 years out, Nick,
Hmm.
so that if we identify that a client is 55 or 60 and they're wanting to retire in 5 years, we need to start the clock because we need to have a specific plan and a time frame that may involve liquidating a number of assets or converting those assets to different types of assets,
Hmm.
or we might need to buy different assets that will assist them in moving towards that goal. So we say to people, don't leave it to 6 months down the track before you decide to tell someone that you're going to retire because it'll be too late. And if it's too late, you'll generally rush things. You'll end up paying more money than you probably need to. Your accountant will look at you with crazy eyes and say, why did you leave it right to this last minute to tell me? So retirement planning, absolutely. It's
Yep.
it's it's vital.
Yeah, and in my industry, I find that a lot of people build their property portfolios 10 to 15 years late. In other words, I
Mm.
mean, this is them volunteering it. They wish they had done it 10 or 15 years earlier, and those 10 or 15 years earlier would have meant that in retirement they probably could have hung on to all of their portfolio because the rents were
Yeah,
sufficient. But
yeah, yeah, I agree.
if people build a property portfolio and they leave it too late, invariably they are going to have to sell something. And if they've got property in super, I would suggest to them that it's probably financially prudent to look at selling the property in super. Not that I'm giving them advice telling them to, but I'm pointing out the obvious. there is no capital gains tax, no income tax applicable to assets in super once they're 60 and retired. So by having property in super as well growing that they can turn around and sell, it just means that they can retire a whole lot of debt that they had in their own name, free up rental income, and of course there was no tax payable.
Absolutely.
All right, well, let's look at a couple mutual clients called Douglas and Susie. Douglas and Susie were first recommended to MRD in 2011 by good friends of theirs. At the time, they still owed a little over $100,000 on their home and had just one investment property that was not giving them very much tax relief at all. Their goals were clear: pay off their mortgage within 5 years, build up their asset base both inside and outside of super, minimise their taxes, especially Doug's, leave them with more and better financial choices in retirement. So I spoke with them about the diverse opportunities that super offers, that is, the ability to use a self-managed superannuation fund to borrow money to invest into property, then receive a percentage growth return on the value of the property or the asset, rather than just the balance that they had amassed to date. And then, of course, as I just mentioned, a tax-free haven in retirement. I explained how they could grow a property asset inside of super and treat it more like a debt killer. So look at the assets they've got in their own name as being that which they're carrying into retirement, but what they're growing in super being literally just a debt killer. And it was imperative that they have their insurances reassessed because their insurances were in their old super. They're at a different stage of life now, so what they took out at the time didn't necessarily have relevance to them now. So to have that completely reassessed and to see if they could find replacement policies that would actually save them some money and have those premiums come out of their SMSF. So ideally, with all else being equal, their super fund would hold and receive a tax deduction for their insurance policies. Now, their first MRD investment property purchase was in Melbourne, and at the time the market was in an upward trajectory and showed great promise. Rental yields in Melbourne tend to be a bit low, and with the results being that they were going to have out-of-pocket expenses to cover, which they were fine with. Their second property with MRD was in Sydney's southwest, and that $415,000 price tag, which seemed a lot at the time for a two-bedroom apartment back in 2012, looks incredibly cheap today. Those units are nudging high sixes and 700,000s. Their subsequent last three purchases saw us take them to the Queensland market, as they wanted to avoid land tax in Victoria and get better rental yields and pursue the next likely to emerge property market. Now, the Sydney market was actually still moving forward at the time, but price points, entry levels were really high, rental yields were pretty low, and plus there was a lot of uncertainty around how much longer the Sydney boom had left to run, and they were just not comfortable investing into that market again at that time. So when Doug actually came and saw me, he came specifically saying he wanted to get one more. He wanted to get his last investment property, and then that would see him done. And we got chatting, and I was talking to him about his super and what he had in super, and I said, have you thought about using your super? And very, very quickly, he cut me off. He said, don't want to be rude, but I've been approached about this before, and as I've said in the past, I'll say it again, I'm not interested in self-managing. I get good returns where I am. I'm happy with the diversification, and I get all sorts of lurks and perks and bonuses by keeping my super where it is at work. I think he got some extra life insurance cover or something. So I said, look, not a problem, but I feel it really important for me to explain what your options are. What you do with them is completely up to you, but I have a funny feeling there might be more options available to you than you realize right now. And he said, okay, go ahead. So I explained to him that self-managing just simply meant you choose the asset when you buy, when you sell, and your level of involvement really came down to your investment strategy, which in the case of property, he'd already done it a few times before. He has a property manager sending him, a statement once a month, putting the rent in. I mean, it's pretty basic. So I explained that and said, your accountant will look after, the auditing and your accounting and send you paperwork to sign. But really, it's pretty basic. And he had an understanding that was based on his brother, who was an active share trader who traded shares every night. And so when he thought of self-managed super, he thought of his brother sitting in front of a computer watching the stock market. I said to him, if you rolled over, for example, a quarter of what you've got, he had 600, so 150, that would be enough for a deposit on a property, and you could still leave 3/4 where you are. And his jaw dropped, and he said, you mean I don't have to roll it all over? And I said, no. You can have as many super funds as you want. And he leaned forward and he goes, so what if I rolled half of it over? Could I get 2 properties and keep the other half there? And I said, I think you could. Anyway, that's what he did. So those last 3 properties, he actually asked to see me because he wanted one in his own name, but he ended up picking up 2 more in super, and is ever appreciative of the fact that he did, because he's going to work. He said he'll probably work till he's 70, and those properties should see one good doubling cycle. Now, no one can say how long a doubling cycle is, but if we're talking 15 years, I think it's relatively conservative, very conservative actually. So one good doubling cycle on those 2 properties, and you see there on the screen that it's not $1 million worth, but it's more than 900,000. So if he makes another 900 to $1 million, just by letting time and inflation drive up the value of those assets, that's net of any future contributions that go in. I think he's going to be a very, very happy person. But it wasn't enough for me to talk to him about this, because I'm not a financial advisor. I couldn't tell him to do it. All I could do was challenge mindsets, paradigms, and get him thinking about it. And then, of course, I had to send him to Dale to get his insurances looked at, to talk to him about, because of his age, maybe some transition to retirement strategies. And Dale, do you want to just tell us what you did for Doug and Susie?
Yeah, absolutely, Nick. So the real issue here for us at the start were 2 things that popped up. One was Doug's age and his income. He was getting slugged by income tax quite heavily, and the insurance components for all of the properties. So based on the recommendations from yourself, and obviously Doug's pretty keen to acquire those first 2, the strategy was that when you have a client with a reasonable income that Doug had, a transition to retirement strategy whereby he was to sacrifice or salary sacrifice a portion of his income into super and start up a superannuation income stream that sits right alongside that particular accumulation product, and then he draws an income from superannuation, effectively saving him around 10 to 15% tax each year, was a considerable saving for him from an income point of view. So that was strategy 1. Strategy 2, if we're going to leave money in super, in his case approximately 50%, then we want to make sure that we've got that in the right particular platform, it's invested the right way. That's strategy 2. And strategy 3 was ensuring that the properties themselves were protected, and that Doug and Susie were protected from an insurance point of view, and we could use their self-managed super fund to help fund that insurance, in particular his life insurance, his TPD, which is total and permanent disability, and also his income protection. So all 3 can be structured inside super. We did have a discussion around income protection and whether we wanted to have that sit outside of super for tax reasons, but generally speaking, due to limited cash flow, super is often the best vehicle to fund insurance, especially if you have a self-managed super fund, then providing the super fund with some more applicable tax deductions, which is always great.
Okay, fantastic. The next couple, Lani and Peter. Now these this couple originated from you, and it was a referral from you to us. So you want to tell us a little bit about Lani and Peter?
Yeah, Nick. So these guys are actually turning 60 next year. They've got their own principal place, which is unencumbered. They've done incredibly well. It's down on the other side of Kawana Waters.
Lovely.
It's had some really strong growth, and that particular property now is unencumbered. Three investment properties worth approximately 1.5, with about 500k in debt, and two of those properties are cash flow positive, one slightly negative. So they've got a retail super fund that we look after to the value of about 600,000, and their plan is, they're at that stage now where we've been working with them for well and truly over a year or so now, just in the retirement planning phase. So getting their assets ready, making sure that when Peter does retire in February, that it's all done. There's nothing to worry about. They can start travelling. Everything's taken care of. The property side of things. It's MRD's job and their role to take up that support role. We want to make sure that the rental on both of those cash flow properties continue, because that's going to provide them with the retirement funding that they need. They may be selling one property, but that's a discussion that we'll have in 2018. And they're just going to focus on enjoying their retirement.
Fantastic. All right, and just one more, Francis and Annette. And the old saying is, if you fail to plan, you plan to fail. Look, like Dale, I could literally tell you stories of real life situations for hours and hours and hours. There are those who have time on their side, and there are those who are racing the clock. And sadly, Francis was 71, still working part-time, and had wanted to invest into property for many, many years. But Annette was never in agreement. Why? Because she had unanswered questions. And those questions they hadn't been answered. I recently sat down with Francis, and he gave me the questions, and it was while I was on an interstate trip, and I said, well, I'm not going to answer these with you now. I'll wait till I'm home. We'll make a time and I'll speak with both of you on the phone. So I did, and I went through the questions with both him and Annette. Now, Annette is a lot younger, still working, and will be working for some time. But there's not a lot we can do with this couple because they just don't have time on their sides. We can possibly help them improve their situation, given that Annette has still got 10 or 15 years worth of working life left in her, and Francis doesn't really look like he's going to be giving up work in the next anything shorter than the next 5 or 6 years. So I feel I get disappointed. I want to help people. I really do. I want to help people, and I know that if they had have just given me one more ingredient, it would have made all the difference, and that ingredient is time. So if we gave you the statistics, would it help you avoid becoming one? I thought of that the other day. I don't know what the statistics are. I don't know. I haven't kept them, like the ratio of people who leave retirement planning until way too late. I figure it's most people, but would it make a difference? My experience is that those with the greatest desire to invest are often the ones that can't. It may be that they're at their age, the banks consider them too old, or assuming that they could even get a loan, they've just left their run so late that there's not enough time on their side to grow an equity pool. Dale, I'm sure you experience the same patterns. And is there anything that you can say to capture the attention of people who don't understand that time is of the essence, and even though they've got 20, 30 years left till retirement, that's actually not a lot of time to grow wealth?
Absolutely, Nick. I'm like you. I like to help people, and there's nothing more frustrating than in sitting down with a couple who might be 25 to 30 years away from retirement, but they're too focused on now. Now, I'm not suggesting that there's anything wrong with that, and that's actually how my business name came about, with Live Now. It's important to live your life right now, but it's also important to plan. And I think it's a combination of both, where we must adopt a very grown-up attitude, where delayed gratification should be our primary goal. It's about making sure that we provide for our families and we do the best that we can right now. But this becomes a very personal discussion, Nick. When you're trying to show someone the importance of developing an investment portfolio, whether it be property, whether it be, or to super, it doesn't matter. It's explaining to them the importance of time. And I often like to draw pictures when I sit down with my clients, and I show them graphs, and I actually explain real life situations, and I speak from the heart when I say that my parents, who are both passed, my dad died at 57 and my mum at 61. It's a very personal thing for me, and they didn't get to appreciate life's rewards. My father died up until 4 months, so he basically worked. Sorry, he worked. He died in April. Yeah, he died in April and of 97, and he was still working up until Christmas that year before. So, and he was only 57. So life can throw you a curveball, and it can knock you on your bum very quickly. So I explain it as a very personal thing, and that's how I try and get inside people's heads, to make them realise.
Yeah. Well, thank you for sharing that. When I was younger, without the expenses that came with starting a family, investing wasn't on my radar. At the age of 30, married with 2 children, living in a home we'd built, I began to recognise the importance of investing for my future, but I told myself that I couldn't afford it. I reasoned one mortgage was difficult enough. There was no way the bank would give me another. I didn't believe it was affordable. Then at the age of 37, I began working in the property industry, and after doing this for a few years, and now with 4 kids at a private school, I continued to assume we didn't qualify to buy investment property. I even spoke at numerous events where I shared my property development and research expertise. At each of these events, the main speaker would tell the audience that the first step was to have their borrowing capacity assessed. They were asked to complete a form and give a snapshot of their financial position so that a qualified professional could assess what they may or may not be able to do. Well, one day I was sitting there and the penny dropped. Realising I had nothing to lose, I had Katrina's and my borrowing capacity assessed, which subconsciously a part of me hadn't done previously because I told myself I'd be rejected, and I guess we all avoid rejection if we can. But to my surprise, we actually had the capacity to get 2 investment properties, which we quickly did. So to sum up, in my early days, I was untrained in finance, unqualified, and literally without a clue. And yet between the ages of 30 and 40, I continued to listen to me. And I made poor decisions as a consequence of my own advice. So I was 40 when I became a property investor. And I feel as though I lost the previous 10 years' growth opportunities. Had I taken action 10 years sooner, had I just said, well, what can it hurt? I'll fill in a form and I'll see. I mean, the worst thing is they say no. But anyway, had I done it 10 years earlier, the equity that we would have amassed would have allowed us to invest into more property, and it goes without saying that we'd have more equity today in all of those properties. More properties with more equity equals more wealth and more choices. So we can comfort ourselves by saying that we learn from mistakes, but it'd be a lot better if I'd learned from others and I didn't have to pay that price myself. So that was what I considered to be my biggest mistake, and I encourage people not to do it. Don't listen to the wrong advice. We've already said that. But when the wrong advice is self-talk coming from you, it can be equally just as dangerous, or possibly even more so. What about you, Dale? you want to tell us what your biggest mistake was?
This was a challenge, Nick, because I've made quite a few. No, I'm just joking. My look, my biggest mistake, and I'll summarise it, is don't sell if you don't have to. Um, my wife and we've been together quite a long time. We met at school actually, and at the age of 20 and 21, we bought our first investment property. It was a little two-bedroom. Actually, no, it was a three-bedroom. It was a two-story townhouse in Maroochydore, and I think we paid 90,000 for this place. It was relatively cheap, so we're talking it would have been early 90s. So it was achievable. We were both employed. We had no children. So we were double income, no kids. We were dinks. And we were living at home with our parents, and life was great. We had no one telling us what to buy or where to buy. We thought we knew, and we just took advice from our parents. Um, but then we decided, well, we need to buy a second property. If we're going to get married, we need somewhere to live. Um, and we found this little three-bedroom place out in the Sunshine Coast hinterland, a little town called Palmwoods.
Hmm.
And it was a little A.V. Jennings house on a quarter acre. It was absolutely stunning. 112,000. That's all I wanted. And this was in 1996. I think it was about 6 or 7 months before we got married. Um, anyway, we went to see the home loan manager. I think at that time she worked for St George. Interest rates were about 8.5% back then. She told us that we should actually sell the investment property so that we could buy this new house. And she explained her reason that it was, that we would struggle financially, that we were possibly going to start a family, and it was all doom and gloom. So we disagreed as we had no children, and we were making a reasonably good income. But due to our ages and inexperience, we just went along with her advice. So we sold and we bought this property. And this trend then continued again in 2003. We decided to move back to Buderim in Maroochydore to build our bigger home for our impending growing family. So we sold Palmwoods, and I actually look back now and the prices of those properties that we sold and what they're valued at now, and it nearly brings a tear to my eye. I know we had a fairly large correction in the property market around 2002, 2003, but I've estimated that we've missed out on about $500,000 worth of capital growth between those two properties. Units, a three-bedroom townhouse in Maroochydore now is around the 350 mark to 400. That property in Palmwoods is 5 to 600. We only paid 112,000. It's just crazy.
Yeah.
So I've learned from this, and I've taken my own advice. We now have three properties. We have a duplex as well, and I've not sold any property since 2006.
Well
Uh,
done.
yeah, it's been a valuable. I look back now and think, did we really have to sell that property to get to where we were? Um, Clearly now is no. But back then, ourselves that it was. But my advice is make sure you understand the long-term effect of selling your property. In fact, any of your assets, and that you may be ripping yourself off if you sold too early. And that's probably my biggest mistake.
Yeah, because the cost is not quantifiable at the time you're selling it. It's quantifiable, you know, in years in the future when you look up what it would be worth. That's when you really work out, as you've just said. And
Agree.
the same goes.
And I've refused.
Sorry, what was that?
Sorry, Nick. I've refused to do that anymore. I used to look back and I'd jump onto realestate.com and look at the prices and see that what they're selling for now, and it was too depressing. So now I've forgotten about that phase, and now I'm just focusing on the next 10 years.
Yeah. Well, the same goes for procrastination. When people delay taking action, even if it's only a delay by 6 months, that's, you can say, well, the prices might have gone up a little bit, they might have to pay a little bit more, but really, it's the multiplied effect of these things at the end of our working lives where we really quantify how much poor decisions cost us along the way.
Totally agree.
So the MRD way is to offer you the support through our partnership so that you can live each day confident in the knowledge that your action plan is being implemented the right way. Of the many MRD clients we partner with, those who achieve the greatest outcomes followed a pretty simple formula. Firstly, we take them through an in-depth discovery session, which is to determine their starting position and the most appropriate way forward. From there, we devise a plan, call it a blueprint. Finally, we intentionally action the plan together, and of course doing regular reviews to tweak as necessary, and this is to ensure that as changes occur to someone's situation or circumstances, they remain on track. And then we work closely with professionals like Dale and accountants to bring in the missing pieces of the puzzle that we don't specialise or carry the licenses in. But right now, your next step is very simple, and that is to determine your borrowing capacity. What your situation exactly is right now. And okay, I'm going to have to do that slide again because I didn't realise that hadn't been edited from the last podcast on rent vesting. Okay, so we go there. That's with the call to action. That's one I wrote. Okay, so I'm just going to start again, Leon, from slide 23 in 3, 2. The MRD way is to offer you the support through our partnership so that you can live each day confident in the knowledge that your action plan is being implemented the right way. Of the many MRD clients we partner with, those who achieve the greatest outcomes followed a pretty simple formula. Firstly, we take them through an in-depth discovery session, which is to determine their starting position and the most appropriate way forward. From there, we devise a plan, call it a blueprint. And finally, we intentionally action that plan together. And of course, we do regular reviews with them to tweak the plan as necessary. And this is to ensure that as changes occur to someone's situation or circumstances, they remain on track. And finally, we work closely with Dale, accountants and other professionals as is necessary to give the clients what we're not licensed to do. Prudent property investing, or really any investing, involves measures to eliminate risk where possible. Going about things in a carefully considered way increases your chances of success as an investor. So don't be like me in my 30s and talk yourself out of further investigation, but take up our offer to illuminate what might be. And at the end of the day, do something. Now, we've got proprietary in-house software that offers you powerful insights into your future. And I'm happy to run through that software with people. So the ball is in your court now. Either let the busyness of life continue to distract you from taking decisive action, and in 5 years now, we know you're going to be 5 years older, but the question is, will you be any closer to your financial goals, or will you have just lost that 5 years time, which is an essential ingredient? Or you can use the link below to phone call us, and we'll phone call you and make a time to look at your current position, determine what your starting point is, and where Live Now and or MRD may be able to add value to your current situation. So that's it. Ball's in your court. End of podcast. Dale, thank you again so much for your time and input. And
Thank you, Nick. It's been a pleasure.
Yeah, and we wish everybody the greatest success in their investment journey, and we look forward to speaking with you in the near future.